Hello, finance fanatics and investing enthusiasts. Welcome back to Investing Lighthouse, your one-stop shop for everything you need to know about investing. Remember to hit that like button, subscribe, and join our community to stay on top of the market mayhem. Now, prepare yourself for an investing showdown. Value versus growth versus momentum. If you're prepared to unravel the secrets behind these strategies, then fasten your seatbelts because we're about to plunge headlong into the wild and unpredictable world of the stock market jungle. Now, you might be wondering, how do I know which style I'm following? Well, if you've got mutual funds or ETFs in your portfolio, there's a chance you're already dancing to one of these tunes without even realizing it. Isn't that a fun surprise? First up, we have value investing, the Sherlock Holmes of the investing world. Like our detective friend, value investors look for clues that a company is undervalued. They peer through their financial magnifying glasses to review financial statements and conference call transcripts and pay close attention to valuation metrics like the price-to-earnings ratio. That's the stock price divided by its earnings per share. If that ratio is low, they might just shout "Eureka!" and snatch up those shares. Value investors aren't always scared off by a company having a rough time. No. They see the potential, a hidden gem. Think Warren Buffett, the legendary investor who once said, "Price is what you pay, value is what you get." He's built a fortune following this philosophy. But remember, value investing takes patience and thorough research. A company with a low PE compared to its main competitors might mean it's undervalued, or it could be a sign of trouble ahead. Value investors are like treasure hunters, most often scanning the stock market landscape for companies with strong fundamentals, solid balance sheets, consistent cash flow, and proven business models, but whose stock price is in a slump. It's like finding a designer dress on a clearance rack. The quality's there, but the price is a bargain. They bank on the market eventually catching up and recognizing the company's true intrinsic value, which can lead to substantial returns. However, as attractive as this sounds, there's a caveat to value investing, and it's called opportunity cost. Since it may take years, even a decade, for the market to fully appreciate the intrinsic value of a company, the money invested is tied up and can't be used for other potentially profitable investments. It's the financial equivalent of waiting for a tree to grow while you could be harvesting crops. It requires an unwavering belief in your valuation of the company and a considerable amount of patience. Just remember, the potential upside of value investing can sometimes be a long game, a marathon, not a sprint. You might have to wait for your financial seeds to grow into a robust money tree. Next, let's hop aboard our investment rocket and venture into the high-risk, high-reward galaxy of growth investing. Renowned investor Philip Fisher, who wrote the book on growth investing, Common Stocks and Uncommon Profits, is an excellent example of someone who follows this approach. When growth investors bet on a company, they're not just paying for what the company is earning now. They're paying for what they believe the company will earn in the future. They're willing to pay a higher PE multiple because they anticipate this company will be the next big thing. The belle of the stock market ball, if you will. But here's the rub. These future earnings are just projections. They're not guaranteed. Let's imagine a tech startup, Future Tech. They've got the buzz, the charisma, the next big innovation. Investors are willing to pay a high PE multiple for its stock, anticipating Future Tech to be the next trillion-dollar company. But let's say Future Tech stumbles. Their innovation hits regulatory roadblocks. They lose key personnel, and their product is not the hit everyone expected. Suddenly, those high future earnings, the E in our PE ratio, start to shrink. But it doesn't stop there, folks. Here comes the double whammy. Disappointed, investors start to think, maybe future tech isn't the golden goose we thought. And what do? They're not willing to pay such a high PE multiple anymore. So the company's stock price takes a hit on two fronts. So while growth investing can feel like riding a thrilling rocket of potential, it's crucial to remember that what goes up can also come down, and sometimes pretty hard. It's always about balancing the potential rewards with the inherent risks. Now let's talk about momentum investing, the thrill seekers of our investing world. Momentum investors ride the wave of a stock's recent success in the hopes that it will continue. It's like they're surfing the stock market, always trying to catch the next big wave. These investors might not care much about the PE ratio at all. Instead, they're looking for stocks that have been on a roll, betting that the upward trend will continue. Think of trend-following commodities trader Richard Dennis, who turned a few $100s into a reported $200 million over approximately 10 years. But be careful, momentum investors. What goes up must come down. If the trend reverses, you could get wiped out. It's like surfing. You need to know when to ride the wave and when to get off. So, which style is the top performer? Well, it depends on when you ask. From 1982 to 2002, value investing outperformed with a 13.5% average return compared to 9.6% for growth stocks. However, from 2012 to 2022, growth stocks roared back with a 16.2% return, while value stocks chugged along at 12.3%. Momentum investing, true to its roller coaster nature, gave returns of 17.2% in some years and just 6.3% in others during both periods. Let's use an example to help illustrate these investing styles. Suppose you come across 3 antique shops, each representing a different investment strategy. The value shop has a vintage record player that seems underpriced. It may require a bit of refurbishing, but you have a strong belief that with some tender loving care, its value could far exceed its current price tag. So, you buy it, ready to put in the work and wait for its true value to shine through. Next is the growth shop, where you spot a rare, signed Beatles album. It's pricey, but given the band's ever-increasing popularity, you believe it'll be worth a fortune in the future. You're willing to pay a premium now for the anticipated future returns. Lastly, you visit the momentum shop. Here, an Elvis Presley memorabilia set has been flying off the shelves. Seeing its popularity, you buy one, hoping to sell it off quickly while the Elvis mania lasts. Now imagine each of these items is a stock. The record player is a value stock, the Beatles album is a growth stock, and the Elvis set is a momentum stock. Each purchase represents a different investing strategy. However, it's not all rosy. These strategies come with risks too. What if the record player's parts are no longer available? What if the Beatles suddenly lose their charm? What if the Elvis mania dies overnight? These represent potential downfalls in your investments. So, which style should you adopt? Well, that's like asking if you should be Sherlock Holmes, an astronaut, or a surfer. Each one has its charms and challenges. And it depends on your personal risk tolerance, financial goals, and even your personality. A detective type might enjoy digging through financials to find undervalued gems, while a surfer might love riding the highs and lows of momentum investing. Whatever the case, remember, investing isn't a one-size-fits-all approach. You can mix and match these strategies or find a new one that suits your style. The crucial aspect is to remain well-informed, maintain discipline, and stay dedicated to your long-term objectives. And there you have it, folks. The epic showdown of value versus growth versus momentum investing. Remember to smash that like button if you found this journey through the investment styles helpful, and share it with your fellow investors. We're eager to hear your thoughts in the comments below about the investment style you adhere to and the rationale behind your decision. Stay curious, keep learning, and as always, remember, the more we learn, the more we earn.